Good afternoon, everyone, and welcome to this session of the Kepler Trust Intelligence Virtual Summit. In a moment, we'll hear from Joe Bauernfreund, CIO and CEO of Asset Value Investors, and manager of AVI Japan Opportunity Trust, or AJOT. AJOT takes an activist approach to investing in Japanese small caps, aiming to benefit from improving corporate governance. Japan obviously has been a relative success story in the current pandemic from a medical point of view. It'll be interesting to see what the outlook is for its companies in what we hope is an economic recovery. Before we start, please note that all your microphones are muted, so we can't hear you, but there's a Q&A function that should be to the right of your screen. And if you write your questions in there, we'll be able to answer those at the end. So with that, I'll pass over to Joe.
Thank you very much, Thomas, and good afternoon to all of you, and welcome to this presentation on AVI Japan Opportunity Trust. I'd like to start by reminding you all of the investment thesis that led to us launching this trust back in October 2018. Essentially, the objective of the trust is to invest predominantly into small cap companies in Japan that have substantial surplus net cash balances sitting idly on their balance sheet, to invest in businesses that are high quality, that are growing their earnings, and to be an engaged, active shareholder to try and encourage managements of those companies to try and improve corporate governance and to try and remedy the undervaluation that we see in those businesses. And when we talk about cash and undervaluation, it's worthwhile looking at some of the metrics because they're truly remarkable. So when we look at the AJOT portfolio, as you see here on the table, almost 50% of the market cap of our portfolio companies is covered by surplus net cash on the balance sheet. And in addition to that, when you include the listed securities that many Japanese companies hold on their balance sheets, the total amount of cash plus listed securities approaches 100%. It's currently 94% of the market cap, which is an amazing store of idle value, if you like, sitting on the balance sheet, but really covers a huge amount of the market cap, which means in effect that when we look at the earnings of these companies, we're paying remarkably low multiples. Currently, that multiple is below 3 times. And to put that into context, it's been as high as 4 times since we launched the trust. When we launched, it was around 3.6 times. And it's been sub 2 times EV/EBIT multiple when it goes back to the period a couple of months ago when the market sold off sharply. But these companies, although they've accumulated huge amounts of cash, they are high-quality businesses. They do grow their earnings in most environments. And that is reflected in the final 2 rows that you see here on this table. When we look at the return on equity, and when you strip out the effect of cash on the balance sheet, these are quite high returning on equity businesses. And that is a key feature. Now, the driver of engaging with companies and trying to improve corporate governance was the implementation 5 years ago of the Corporate Governance Code in Japan, which has encouraged more shareholder engagement, more interest from both domestic and foreign investors to try and get Japanese companies to improve their rating and to remedy their undervaluations. Now, just a quick word on Japan's experience with COVID-19. As Thomas alluded to in his introduction, Japan has escaped relatively unscathed when one looks at the deaths and when one looks at the cases. Japan has a cluster-busting system which seeks to identify where the outbreaks are and to try and close those off. And they've had a huge amount of success with remarkably low cases. Japan is out of lockdown and the economy is starting to get back to normal. So although some of our companies suffered as a consequence of lockdown both domestically and globally, a lot of those earnings are coming back, in some cases quite strongly, and the portfolio companies are well placed to participate in the broader recovery that's starting perhaps to occur. So when we look at our portfolio companies, clearly cash on the balance sheet is a key component. And as you see here, many of the companies have blindly accumulated huge amounts of cash on their balance sheet. That's a combination of cash flow generating businesses with fairly modest payout ratios. And even what's important is even in the last year, which has been a difficult year for Japanese companies, not only have they had to deal with COVID in the last quarter, but the whole US-China trade war really affected many companies. But nevertheless, cash has continued to grow on the balance sheets. And likewise, cash plus securities, which you see here on the right-hand side, and even with share prices having suffered, the NFV remains remarkably wide. And as you see on the right-hand side, when one looks at the NFV, since the inception of the fund towards the end of 2018, the levels that we're at now are simply well beyond anything we've seen, which really highlights how much cheaper the portfolio has become really pretty much during 2020, this year, as the COVID sell-off has really hit valuations. Now, our portfolio is very diversified. It has a tilt towards domestically exposed businesses. It has underweights in sectors such as banks, which have not been a particularly attractive area to be in Japan. It appears on the surface to be exposed to some cyclical companies through capital goods and materials, but it's worth looking through that at some of the subsectors to see some really good quality businesses in areas that are quite stable, and actually some have been totally unaffected by what's gone on with COVID and with lockdown. For example, Fujitec, which is a big position for us, the elevator and escalator business, is really driven by long-term stable maintenance contracts. So those don't tend to be affected by the short-term impact of COVID. Likewise, companies such as Teikoku Seni, which is a disaster prevention company, and Sekisui Jushi, all involved in infrastructure. But again, there are long-term spending plans for their products, and those tend not to get hit or postponed by any short-term events. So it's a very well-diversified portfolio, deliberately so, but tilted towards more resilient and domestic sectors. Now, quite a lot has been written recently about Japan's attitude towards shareholder engagement or shareholder activism. There have been cynics for many years when we've argued that Japan looks cheap and Japan is changing, and the opportunity for activist shareholders is really growing. But in recent months, a couple of factors really have led to an increase, perhaps, in some of the challenges. Many of our companies, as I've said, have got huge amounts of cash on the balance sheet. That is part of the Japanese culture, to preserve cash for a rainy day. As a consequence of that, some people have suggested that activists who, to an extent, ask for some of that cash to be returned to shareholders will now face the challenge of arguing that that cash should be returned to shareholders, because in a sense, the Japanese attitude has been vindicated. No Japanese company has had to go cap in hand to the government or to shareholders or to banks. They all have ample cash balances with which to continue to pay their staff, pay their pensioners, which is a fundamental value amongst Japanese companies. And in addition to that challenge, there have been recent regulations implemented that appear on the surface to make it more challenging for foreigners to take stakes above 1% in companies, and to try and restrict some of the things that they can do as shareholders of the company. And I'm pretty convinced that neither of those reflect an impediment to what we are trying to do in Japan. On the regulatory front, on the FEFTA regulations, the rules allow for exemptions for investors such as ourselves who are regulated asset managers. And as long as we're not intending to put ourselves on the boards of companies or propose that we intend to cause the company, encourage the company to sell off a core business, then there is no restrictions on us taking shares, there's no restriction on us submitting shareholder proposals or continuing to engage with management. On the cash question, the vindication of having cash for a rainy day, I think the argument that this sounds the death knell of shareholder activism in Japan miss the point. Ourselves and most of the other activists in Japan, yes, we focus to an extent on inefficient balance sheets and some of the cash that has accumulated. But we understand the way corporate Japan conducts itself. We don't ask for all of that cash back because we know we'll never get it back. What we ask is for a focus on shareholder returns, a focus on improving corporate governance and improving operational strategies. Cash and share buybacks is just one element of how we seek to engage. And even when we ask for cash back, we're asking for fairly modest share buybacks as a first step towards encouraging companies to focus on returns. So that will continue. The response from companies to engagement from all types of shareholders has been on a dramatically improving trend over the last couple of years. We've seen good responses from companies. And whilst one or two companies may use COVID as an excuse, I think for the most part, the quote here that we've put from Leo Lewis, the FT journalist, I think captures the sentiment in Japan. And that is that increasingly companies are beginning to recognize that so-called activists are actually trying to be constructive shareholders, trying to benefit specific companies, benefit Japan, and we're not there really to be aggressive bullies. And that I think is very, very important. So the scope really of our engagement is quite broad. It's not about embarrassing companies. It's not about always submitting shareholder proposals in public. It's a range of activities that we seek to improve overall corporate value in a number of ways. And as I said a moment ago, yes, we can improve returns on equity by encouraging better use of cash or return of that cash to shareholders. But increasingly, what we're seeing from both ourselves and other investors in Japan is that there's an increased focus on broad operational and strategic issues to try and really gain a broad support base as possible from all shareholders, not just foreign shareholders, but also importantly from Japanese domestic institutions who want to see these companies be strong, to grow and be successful, rather than one-off boosts in share prices that may arise from share buybacks. So to that end, AVI recently launched a public campaign at our largest holding, which is Fujitec, the elevator company I mentioned a minute ago. And whilst we covered some of the capital inefficiencies that exist in Fujitec, such as too much cash on the balance sheet, roughly half the market cap is in cash, and whilst we alluded to the cross-shareholdings on the balance sheet that should be returned to shareholders, the bulk of this 73-page presentation, which you can see at the dedicated website, really focuses on operational inefficiencies, strategic opportunities, and is a whole raft of suggestions that we've made to encourage the company. And I think this increasingly will be the mode of engagement that you'll see in Japan. It's not hostile. It seeks to be conciliatory. It seeks to be helpful and constructive. And after many, many years of mismanagement or passive management in a lot of companies in Japan, it's these kind of improvements that management are not always on top of, they're not always aware of, and really have huge scope for upside. So, as I've said, the landscape in Japan over the last couple of years, when it comes to the success of engagement, has really improved dramatically, even over the short period since we've launched the trust. We've had a couple of companies taken over by parents. We've had a number of companies embark on share buybacks. Probably half the portfolio companies have done some form of share buybacks. We've started to see unwinding of cross-shareholders. And most of our engagement takes place in private. It's not in the public eye. We have done three public campaigns, but we tend to get very good results from being long-term, being patient, trying to cement very constructive relationships with the boards of these companies. I mentioned a moment ago that we've had a couple of companies taken over. And I just want to spend a few minutes. I don't have time to talk about many examples, but this theme of parent subsidiary listings that is common in Japan is a very important theme, and one which has got a tremendous potential to unlock huge amounts of value. So in Japan, it's common to have large companies own 50%-ish of listed subsidiaries, and to effectively control those businesses, to consolidate the earnings, and to have unfettered use of the cash that often sits in the subsidiary companies' balance sheets. And whilst that has existed for many years in Japan, it's clearly not in the interests of minority shareholders. It acts as a poison pill, and it promotes interests other than those that are to our benefit and to our advantage. So over the last few years, since the implementation of the Corporate Governance Code, there's been an increased focus in the parent-child subsidiary listings, and there's been mounting pressure on companies to consolidate their subsidiary portfolios by either buying in those businesses or by selling them off, typically to the large number of private equity investors that are growing their presence in Japan. We had 2 Toshiba subsidiaries acquired at substantial premia at the end of 2019. And we currently have approaching 20% of the portfolio invested in such companies. And that's a growing number, because we see tremendous potential for those catalysts to unfold. And I'll just highlight one company, just to highlight the enormous amount of value and the inefficiency that exists in these parent-child listings. So this company is Secom Joshinetsu, which is a burglar alarm security company. It is a subsidiary of the larger company called Secom, which operates in exactly the same business. The difference being that Secom Joshinetsu focuses on just 3 prefectures, 3 regions in Japan. It's a highly, highly attractive business, rather like Fujitec with the elevators and the maintenance contracts. The bulk of the profit is earned from long-term maintenance contracts and the periodic upgrades that consumers make on their alarm systems. And you see that reflected in a very resilient and stable operating profits profile over time. Now, in the case of Secom Joshinetsu, they've averaged a 30% payout ratio over time. It's a highly cash flow generative business, and cash has continued to accumulate blindly on the balance sheet, such that currently over 80% of the market cap of Secom Joshinetsu is covered by cash. And when you look at the valuation of Secom Joshinetsu compared to its parent company, which after all is operating in the same business, it's really quite remarkable. So it's a similar business model. They've had the same profit trajectory over the last 5 years. The operating margin in Secom Joshinetsu is quite a lot higher than it is in Secom Group. I've mentioned the cash in Secom Joshinetsu. Secom has got a strong balance sheet, but nowhere near as strong as Secom Joshinetsu. But when you look at the difference in valuation, it is very, very striking. The EV/EBIT multiple on Secom Joshinetsu is 1.1 times, and it's 11.5 times for the parent. So there's huge scope to unlock a tremendous amount of value. Either the parent should want to acquire that, and we should try and benefit and capture a huge amount of that undervaluation. But clearly, as it is a controlled situation, we can't force SECOM to buy out the subsidiaries, but we can put pressure on directors, on independent directors, to ride that wave of improving corporate governance and to increasingly get companies to focus on these inefficiencies, to focus on undervaluations, returns on equity, and the trend of boosting shareholder returns. So this is a top 5% position. It's typical of a number of our companies in the sense that it's quite illiquid. It's about a £300–400 million market cap, but it can be quite illiquid, which means that at times like in March, where we had sharp sell-offs in the market, the price moves can be quite extreme and they can be quite irrational. Those present opportunities for us, and using the benefit of our closed-end structure, the available resources to us, this was a kind of company that we were adding to quite heavily during the sell-off as valuations became extremely irrational. And when you look at the portfolio as a whole, and you see the column marked NFV as a percentage of market cap, that's the cover of cash plus listed securities market cap. You see some pretty remarkable numbers there, and those numbers generally increased quite dramatically during February, March of this year. And over the long term, what we've seen is that 100% cash to market cap ratio tends to be a line in the sand. Obviously, when markets are panicking, you tend to see it move beyond those levels and tend to see extreme moves, but it tends to correct. And that's what we've started to see over the last 6 months. We've started to see that normalization. But being small caps, being not covered by research, being less liquid, there is often a time lag between some of the larger companies re-rating and these. So what we see here, the overall valuation, is still very much at the lower levels since we've been running this trust and since we've been monitoring the universe, and presents some very good opportunities. So going forward, when we are speaking to our companies and trying to ascertain the impact, the overall picture is that they've suffered slightly in some cases, to a greater extent in others, over the first quarter of this year and probably over the second quarter as well. But the vast majority of our companies, I think with one exception, will generate free cash flow this year and continue to boost the cash piles. Earnings across the portfolio will be quite resilient. And the opportunity for shareholder activism to continue to engage, to continue to build dialogues with companies and to unlock value is opening up as company management become more and more responsive to the engagement and more trusting of the approach that we are taking in Japan right now. So with that, I'll end and be happy to take any questions if there are any. Thank you.
Thanks very much, Joe. Yes, certainly we've had quite a few questions. Perhaps we could start. There's a couple of questions asking about the overlap between AJOT and AVI Global, and what specifically does AJOT offer which you can't get at a discount in AGT?
Yeah. So you're right, AGT has substantial exposure to Japan. It has roughly 30% of its NAV invested in Japan currently. It has about a dozen holdings in Japan, whereas AJOT has 25 holdings in Japan. The overlap is roughly 50%. The 50% that appears here in AJOT but is not in AGT tends to be some of the smaller companies, some of the less liquid companies. Something like SECOM joshinetsu, for example, is not in AGT. And that tends to be where the most extreme underpricing exists. So you get some of that in AGT, you get other things in AGT as well. But as far as Japan is concerned, you get more of the very extreme undervaluations in AJOT.
Great. And a question asking us a bit about, so once you've got your you've done your screens and you've got your companies, the cheapest companies, how do you select specifically the ones that you invest in?
Yeah, so I mean there are a couple of things that we need to take into consideration. It's not only about cash on the balance sheet and the perceived undervaluation. So we are looking at the quality of the business, the resilience of the earnings, the potential for those earnings to grow. And that forms part of our fundamental analysis. But the other very important angle is, as I said, shareholder engagement. The idea that we, as a shareholder, try and promote higher standards of corporate governance and try and encourage the boards of these companies to do better things. And for that, we often need support of other shareholders. So a key element of our due diligence, if you like, is who those other shareholders are and how likely they are to be receptive to the kind of suggestions we might be making to those companies. If you find a company in Japan that's dominated by a cozy cabal of cross shareholdings that are likely to support management at all costs, then that's going to be an uphill struggle for us and probably going to be a waste of our time. Whereas if you've got a register that's dominated by foreign investors or by other activists, be they domestic or foreign, then you're more likely to be alongside investors who are going to articulate the same arguments as we are, and that can be very helpful.
And on management teams specifically, so there's a question about, Japan obviously has a relatively distinctive culture and has had perhaps an ingrained patterns of corporate behavior. What are the incentives for company management teams to take a different attitude this time?
That's an interesting question, and it touches upon one of the challenges we face, which is that in many cases, the senior management of these companies do not own shares, do not own a great deal of shares in the companies. So to that end, when we start engaging with companies and we start writing to them and meeting them and asking them to make certain improvements, pretty much in all cases, one of the things we suggest is share incentive schemes for management. And that really starts to align the interest and starts to get them to focus on the share price rather than it being a very abstract phenomenon. And we've had quite a lot of success on that front. There is a growing trend from a low base of executive share incentive schemes. So that is an important element of alignment of interest. And the other consideration is cultural. This corporate governance movement that's started to unfold with the implementation of the Corporate Governance Code and Stewardship Code is a national phenomenon, and Japanese people feel it's their duty to sort of support and participate in that. And as more and more companies are starting to focus on returns on equity, on shareholder returns generally, it becomes the norm to do so rather than the exception. And in Japan in particular, that's a very, very powerful force. We saw it with share buybacks. So many companies now are buying back their shares, albeit from a massive increase, albeit from a low base, but that's because it's become acceptable. And that seems to be the trend in Japan. You can push and push and push and encourage companies to do certain things, and you can face some pushback. But once sort of the door opens, you get more of a stampede and more people participate in it.
And when it comes to your portfolio, can you give us some idea of the revenue breakdown? Is it domestic Japan, or how much is from overseas?
Yeah,
and then perhaps I could tie in a question specifically about China. So is Japan and your portfolio benefiting from any manufacturers moving from China back to Japan?
Well, the majority of the revenues are domestic, I would say. Somewhere between 50 and 60% are domestic. There is an element that straddles both. So component manufacturers for Japanese car manufacturers are exposed. They're somewhat domestic, but they're also exposed to the global supply chain and global economy. But somewhere between 50 to 60% is really pure domestic, and those are the ones that tend to have quite resilient earnings, and in some cases have benefited actually quite sharply from lockdown in Japan. We haven't yet started to see factories sort of come back to Japan from China, but I think, as is the case in other parts of the world, that is a discussion for many companies. We'll see how far it goes.
It's been noted that the gearing is quite punchy on the trust, and it's risen this year. Could you talk us through that? Was that a response to the crisis, or how have you been investing it?
Well, you're right, we do have some gearing, and I think up to the run-up, up to the sell-off at the start of this year, the average gearing level was around about 110%, and that's been fairly consistent. It obviously went up temporarily as markets fell quite sharply, and I think it might have touched 115% or 15% gearing at one point in February, March. It's now about 6%, so we're about 106% invested, and we have quite a lot of firepower available to us if we wanted to increase the gearing. But I think that structurally, somewhere around 10% fairly consistently is where we and the board are fairly comfortable with the gearing being.
And a question about NAV performance. So it appears that the NAV has fallen a bit more than the market. Is that true? And if so, what's been driving it?
Yeah, so when one looks at the 2020 performance, and you can split it really into a game of two halves, you have the first part up until the end of March, which is when the market sold off, and then you've had the recovery since the end of March, or the bounce since then. And it's certainly true that over the entirety of that period, we've lagged the broader market and some of our peers as well. In the sharp sell-off, we underperformed very slightly the broad market. In the recovery phase, we've lagged behind, and that's a function of the more value style, I would say, of our companies. The fact that they are not on many investors' radar screens, they are not covered by sell side, they're very small caps, some cases not particularly well known. And we saw even in the summer last year, there tends to be a bit of a lag between markets starting to recover and then them catching up. So thus far in the bounce that we've seen in markets, it's been the very high growth companies that have led the way, technology companies, some consumer healthcare, consumer staples businesses, which we have less exposure to. So, but I think the encouraging thing from our perspective is that actual valuations have become cheaper in that sell-off, and I'm confident it's only a matter of time until we see that normalizing and starting to correct.
I have a couple of questions about the resources that you have to apply, particularly given in the local market and given the language barrier. What resources do you have, and how have they grown as you've invested more in that part of the world?
So you're absolutely right. Our resources have grown, and what I'm showing you here is some background into the Japan resource. So when we launched the trust, it was myself and Daniel Lee who were the entirety of the Japan-focused team at AVI. And since we've launched, we've gradually increased our resource. We've hired a senior consultant who's based in Japan, who's a native Japanese guy called Jason Bellamy, and his remit is to develop relationships with the senior management of the companies we're invested in. He's obviously on the ground there, so it's much more efficient for him to do so, and being a native Japanese, he doesn't have a language barrier. And it's very important in Japan for presidents and directors of companies to feel comfortable with AVI as a shareholder, and a key element of our approach is to build that trust. And having somebody there on the ground who can cement that and take that further is very helpful. So Jason joined us this year, a couple of months ago, and is developing our relationships. We've also hired a Japanese-speaking assistant who works with us in London. Again, she's a Japanese national but has been living here for 20 years. So she helps on logistics, on translations, on communicating with companies generally, as well as some research as well. So that's again another boost to our resource. And then I think very interestingly is the analysts that you see here. We have an off-cycle intern who's negotiating an exit for his employer, so we don't give his name. But he intends to join us as a full-time analyst, having worked with us part-time for a few months. He's a Japanese ex-investment banker and will be based in London to start with, but obviously doesn't have any language issues. And we've got a summer intern at the moment who has a similar background. He comes from a consultancy background. He's working with us this summer and potentially will join us full-time next year. So there's been a dramatic increase in the resource. We've boosted our language capabilities, we've boosted our presence on the ground in Japan, and that will be a continual evolving process, I think.
Great, and a couple of people have asked if the managers invest alongside investors in AJOT.
Yeah, very much so. So first of all, as part of our fee arrangements, 25% of the management fee that AVI gets is invested in the shares of the company. So roughly at the moment we have about 500,000 shares owned by AVI Management Company. In addition to that, I think the number is a similar amount, at least, if not greater, that individual employees at AVI have invested in the company as well. So it's well over £1 million in total that we have invested here.
Great. We have a couple more questions in the hopper, but please do add yours if you wish, as we do have a few more minutes if you have something to ask. We have a couple of more perhaps macro questions here. So in terms of Japan's demographics, can you give your view about the impact that's likely to have on the market? It's also been raised the issues of increasing number of foreigners moving to Japan, which perhaps hasn't happened in the past, and a growing student population. How significant are these trends?
Well, the demographic issue in Japan has been flagged as a potential looming problem. Thus far, it doesn't seem to have had a major negative impact, I would say, on the economy. That's not to say that it won't at some point in the future. I think the greatest impact we've seen for now has been on the employment market, and the fact that graduates and school leavers don't have a problem really getting a job. There are more jobs available than school leavers and graduates, and that is slowly but surely starting to have an impact on wages, which I think is a very important element here in order to gain traction on the inflationary front and to get the consumer spending and get animal spirits going. It's an aging population, and so that does create a burden on the declining working population. So there has been more talk about Japan becoming more open to allowing foreigners to come and work in Japan. We're starting from a very low base, but we've started to see some improvements on that front and some greater degree of welcome, I would say, for some foreigners to come to Japan. And I suppose that is probably a trend that we're likely to see continuing. At the same time, it's interesting that our two Japanese analysts are very keen to come and work in London as well.
Right. Which perhaps brings me on to my next question: is should we be concerned about the disputes with China over various territories, and is that impacting valuations in the market and maybe the decisions of your analysts to move to London?
I don't think so. I don't think that that's an issue. I think there are bigger issues to worry about in the world than Chinese, Japanese spat. I think on the most part, many of the Japanese companies that we have are very comfortable investing or making capital projects in China, and vice versa as well. So I see that as a less serious issue than some of the others.
And there's a more broader question about currency, which I take as being regarding the yen, and how that impacts the portfolio.
Well, first of all, this is an unhedged portfolio based in pounds, so we take on the nose the full yen exposure. Some of that is mitigated by having yen debt, but essentially this is a yen portfolio. So any fluctuation will affect the NAV of the trust. We tend not to be exposed to the very large exporters whose profits tend to be very sensitive towards fluctuations in the yen. And as I said, the majority of the revenues are domestic. The majority of the businesses are exposed to the domestic economy. So we have some insulation from yen volatility affecting operations. The yen has been remarkably resilient over the last couple of years. It's been trading in a relatively tight band against the dollar in particular. There's obviously been more volatility against sterling because of Brexit issues and economic issues here. By many accounts, the yen appears to be undervalued and is due at some point a re-rating. And we're pretty comfortable actually having yen exposure.
So I have a question regarding sort of who is investing in Japanese equities. So senior managers are not investing in their own business. Who is behind flows into Japanese equities?
Yeah. I think that's a very, very important point. And thinking about your earlier question about whether China-Japan spats is affecting valuations, I think fund flows are a major factor here. The sense has grown over the last few years that really the markets you have to focus on and get right are the US and China, and everything else is quite secondary. And Japan just has had less interest from the large investor flows. So in terms of who's buying the Japanese market, the central bank is a large buyer of Japanese equities, a large owner of Japanese equities. The government pension fund is a major buyer and is a top 10 shareholder of pretty much every company in Japan, and that continues. That's a trend that continues. The Japanese retail investor base are quite active, in some senses quite speculative, but a large number of Japanese retail investors or consumers are fairly risk averse and were burnt in 1989 when their bubble burst and have steered clear of the stock market. But that is a trend that is gradually starting to improve. They've introduced ISA-like products a few years ago, and share ownership is growing. And then you've got the foreign flows. There's a great deal of interest in Japan from large institutional investors around the world. It stands out remarkably on valuation grounds. The signs of improving corporate governance and shareholder activism are very encouraging, and it therefore piques a lot of interest. But still, the flows tend to be net slightly negative, although we have some periods of stronger inflows. And that really remains the challenge for Japan. It continues to be a market that is overlooked by many.
And does the trust benefit from the government buying? Does the pension fund buy small caps, or is it?
Yeah, they do. The government pension fund does buy small caps, but obviously the money is weighted towards larger cap companies. One important way in which we benefit from, for example, the government pension fund investing in the market is the attitudes towards shareholder engagement. So GPIF, the government pension fund, is the largest investor in Japan, and they farm out their money to a large number of effectively tracker passive managers. both domestic and foreign fund managers and banks manage money on behalf of GPIF. And they typically own 2,000 shares like any tracker. But the fee that they earn is based upon the alpha or the upside they generate from engaging with management. And typically these managers will put 10% of their portfolios into an engagement bucket where they will proactively engage with those companies and try and improve returns. And if that generates alpha, they earn a fee out of that. And that attitude is starting to have a spillover effect on the broader market. It's why we've started to see improving attitudes from Japanese institutional shareholders towards our kind of shareholder engagement, because increasingly they're being encouraged to do the same thing. And at the same time, it's also why we've started to see more responsiveness from Japanese companies, because now it's not only the foreigners who are asking for things to be improved, but it's also the domestic institutional shareholders, and their voice is clearly a lot more powerful than ours. So there are a good number of positives to come out from that buying.
And I think our final question here, so presumably you're looking to increase the size of the trust. Should we expect further tap issues if and when the premium to NAV returns?
Sure. We'd certainly like to increase the size of the trust. We had plans and had support to increase the trust in around March, April time, but obviously the sell-off that occurred at that time put those plans on hold. So our plan is to gradually grow the trust. We have a cap of around £200 million on the size of the trust, and that really reflects the realistic size of the opportunity, the fact that we want to have a concentrated portfolio, and we want to be able to exploit those small opportunities that I described earlier when talking about the difference between AGT and AJOT. So yes, if and when we get back to a premium, we would certainly look to modestly increase the size of the trust.
Brilliant. Well, thanks very much, Joe, for your presentation and for your very full answers. For the audience, please note that the presentation will be available on the website, hopefully on Friday. 1:45 this afternoon with William Meaden of JPM Colourhouse. So thanks very much, Joe, and thanks to the audience.
Hey, thank you very much.